Gearing has traditionally been viewed as a higher risk approach to investing, but ETFs are increasingly changing the game. Today we're going to take a closer look at this growing space. Welcome to The Pitch. I'm Sarah Allen and today I'm joined by Cameron Gleeson from Betashares. Cameron, welcome.
Thanks Sarah, great to be here.
To begin with, can you give me a quick overview of how gearing works in ETFs?
As a general concept for getting the ETFs, gearing is the idea of using some of your own capital and borrowing capital to invest in an asset or an investment. So for example, if I had $2,000, I might decide to go out and use an investment loan, like a margin loan, borrow $1,000 to invest $3,000 in a market. Now, with regard to a geared ETF like G200 or GHHF, you would simply invest that notional $2,000 in the ETF, so buy units of the ETF on the ASX. The fund itself will borrow the $1,000 and invest the total capital of $3,000 into the underlying portfolio. So unlike when you need to go out and actually borrow that money yourself, that pain factor goes away. You don't need to go through the loan application process. And in fact, because you're using effectively an institutional investor in Betashares to manage that borrowing, you're able to access much cheaper rates of borrowing too. So there's a lot of advantages to this pre-packaged solution.
So you mentioned margin loans there. Could I get a margin call on a geared ETF?
Yeah, so with a geared ETF, you will never be subject to margin calls and you will never be required to repay the loans. Again, one of the great advantages of this solution.
How do you manage the cost of borrowing in a geared ETF?
So with these ETFs, the cost of borrowing, or the interest if you like, is paid by the fund, not by you as the investor. But critically, because this fund is managed by an institutional investor in Betashares, we're able to access institutional rates of interest, which are typically far lower than an individual such as ourselves could get when they're looking to use an investment loan to buy a house or shares. So it's a really cost-effective way of getting geared exposure to the market.
You've recently launched 2 new geared funds. What level of gearing is used in G200 and GHHF and how do you manage this?
So the funds are managed such that their LVR, the loan to value ratio, sits between 30 and 40%. Now what this means is on an exposure basis, in terms of your exposure to daily movements, you're going to see the fund move up or down in value by approximately 142 to 167% of that underlying portfolio movements. So think of this roughly as around about 1.5 times leverage.
What impact does gearing have on the returns?
So if we take a fund that was 1.5 times levered, if we think of the daily movements in its underlying portfolio, say if those movements were 2%, your change in the value of the fund on that day would be 3%, right? So 1.5 times 2%. Now, that gives you an idea as to the short-term relationship. Over the long term, you're also going to see that the returns of the fund are also impacted by compounding over time, as well as rebalances, the cost of the interest and the management cost of the fund. But in simple terms, for a geared investment solution to outperform the ungeared equivalent, you need to be able to invest in an asset or an investment which has the potential to generate capital growth and income, which are going to be greater than the interest burden over the long term.
Thank you so much for sharing your insights today.
You're welcome.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.